This week, the Bank of Canada cut rates once again. Are we at the bottom of this cycle, or is there a surprise coming? Plus, Ottawa is gearing up to drop a massive federal budget, and it could completely change the path for interest rates and for housing. We're going to break down how an $80 billion plus deficit could keep borrowing costs higher for longer, and what that means for buyers, investors, and renters alike. Meanwhile, new building permits are collapsing. Project cancellations are hitting records, and rental construction is surging, just as student demand plummets. And in record mortgage renewal pain, a shaky job market, and confidence levels not seen since the financial crisis. And that is all creating the perfect storm for shaping Canada's housing future. By the end of this episode, you'll know exactly where the market is heading next. So first off, we're going to talk about what happened with the Bank of Canada. And just prior to Wednesday morning's announcement, the market odds of a rate cut reached as high as 90%. And ultimately, the markets were right again. The Bank of Canada delivered its latest interest rate decision, and yes, it's another cut. The overnight rate dropped by 25 basis points, bringing it down to 2.25%. Now, while this move was clearly widely expected, it comes at a fascinating crossroads for the Canadian economy. On one hand, we've got a jump in inflation, up 0.5% in September, and surprisingly strong employment numbers with over 60,000 jobs apparently added just last month. But on the other hand, growth is weakening, employment sits at 7.1%, and the fallout from the US trade tariffs is starting to take a real bite out of Canada's GDP. In fact, the bank explicitly said those tariffs are, quote, fundamentally reshaping Canada's economy. That's a big statement, and it helps explain why Governor Tiff Macklem and the Governing Council are keeping their focus on stability. Their message was clear. The current policy rate is about right to keep inflation close to 2%, while helping the economy adjust through this period of structural change. So what's the outlook going forward? The bank expects GDP growth of just 1.2%, another 1.1% for 2026, and only a modest pickup to 1.7% in 2027. That's a pretty sluggish recovery path. Inflation, meanwhile, is projected to hold around 2.5% before easing slightly as trade pressures and supply issues calm down. At this point, the bank believes it can continue to support the economy without reigniting inflation, which is why it's easing rates even as some headline numbers like jobs and consumer spending appear strong, at least on paper. Now, let's talk about what this means on the ground, especially for housing. At 2.25% overnight rate, we're sitting right at the bottom of what the bank considers their neutral rate range. Any lower, and it moves monetary policy into a position of which would be called or considered stimulative. Mortgage rates could start to edge a little lower, giving some temporary relief to variable rate holders, but it's not likely to spark a massive buying surge, especially when we saw what happened in the bond market. Those spiked overnight, on the announcement, and they've eased slightly, but still maybe not too much relief in the fixed rate mortgage world. The bank itself admits the labor market remains soft and that confidence is fragile, especially with continued uncertainty around this good old US trade policy. The economists weighed in on the announcement. Scotiabank's Derek Holt says the bank is, quote, nearing the end of its rate cutting cycle, warning that real rates, are now basically zero when we look at it compared to the inflation rate. And that's just not sustainable, at least not long term. Desjardins' Randall Bartlett agrees, saying the bar is high for no future rate cuts and expects the BOC to hold rates steady for at least the foreseeable future. And CPA Canada's chief economist, David Alexander Brassard, put it bluntly, the bank is stepping aside and handing the baton to Ottawa. This is obviously based on the upcoming budget. The last point is key because the federal budget is due November 4th, and all signs point to the next round of stimulus coming from fiscal policy, not monetary policy. In other words, the government will have to pick up where the Bank of Canada leaves off. So where does that leave us? Well, the Bank of Canada seems content to pause here. But if growth falters again, or if the US trade situation worsens, another small cut could come around the end of this year or early 2026. For now, the takeaway is this. Rates are potentially as low as they might go, with the potential, again, of that one or two cuts by the spring. Lots of economic data to come in prior to them making that decision. The economy is in adjustment mode, and the housing market, particularly here in Vancouver, is entering a period of what kind of feels like cautious stability, definitely far from any type of rapid recovery. In short, the rate cuts may not be over. It's all coming down to jobs and GDP growth over the next few quarters. Interestingly, the October real estate numbers for GVRD are showing signs that we may end the month with one of the highest sales volumes and prices for the year. But more on that at the end of today's episode.
Yeah, and to touch on that further, really to get into what Dan's talking about here, which is the budget. Ultimately, if the Bank of Canada is going to slow rates, then that means the government is going to spend. You got to think, with a massive budget on deck, what kind of inflationary numbers are we going to see? Now, while the Bank of Canada just made headlines with its latest rate cut, there's another major event coming that will completely reshape the outlook for interest rates. And that's the federal budget, the 2026 federal budget. And that drops on November 4th. And here is where it gets interesting. Media reports suggest we could be looking at a federal deficit as high as $100 billion. But if history is any guide, that's probably the government's classic move of floating a big, scary number in front of people to let everyone panic for a week and then swoop in with something smaller to look a little bit more fiscally responsible. So realistically, we're probably talking closer to an $80 billion deficit. Nonetheless, that is still a massive deficit. Now, to put that into perspective, that would amount to roughly 3% of Canada's GDP. And while that's less than half the size of the projected US deficit, it would still be the largest non-crisis deficit that we've seen in nearly 30 years. Only the 2009 financial crisis and the 2020 and 2021 pandemic years have surpassed that kind of spending in modern Canadian history, and likely for good reason. So why does this matter for the Bank of Canada and for you? Because when the federal government steps on the fiscal gas pedal, spending heavily to stimulate the economy, it takes the pressure off the Bank of Canada to do the same through monetary policy. In simple terms, if Ottawa is flooding the economy with spending, the Bank of Canada doesn't need to cut rates so aggressively to keep things moving. And that creates an important dynamic for the housing market. More government spending typically pushes up demand across the economy, but it can also lead to higher interest rates over time, as the bank works to offset the inflationary effects or as bond markets demand higher yields to finance that debt. So while some Canadians are hoping for another rate cut early next year, a big fiscal package in this November budget could actually keep rates higher for longer. It's a delicate balance, and one we'll be watching closely. But if the government goes full throttle into stimulus, expect the Bank of Canada to hit pause. But if the spending comes in lighter than expected, it's very possible that might reopen the door for smaller cuts in 2026. Either way, November 4th is shaping up to be a pivotal date, not just for economists, but for homeowners, investors, and anyone watching the tug of war between monetary and fiscal policies. On top of this, business confidence remains exceptionally weak, hovering around the mid-40s, a percentage level we've only seen 4 times in the past 25 years. It was during the global financial crisis, early COVID lockdowns, right after the surprise 100 basis point hike in 2022, and now in the early stages of the current US-Canada trade dispute. So what's the bottom line? This isn't just another budget. It's a test of how far the government is willing to go to stimulate growth, and whether the Bank of Canada will have to pump the brakes right afterwards.
So now let's talk about the future pipeline of homes and supply, as it will play a major role in pricing, especially if we see interest rates in the stimulative range down the road. Over the past 3 months, single-family home starts dropped 9.5% relative to 2024 levels, with condos down about 4.5%. But rental starts are up over 26%. On a 12-month rolling basis, we're sitting at 110,000 rental unit starts, which accounts for nearly 50% of all starts over the last year. This is a record amount by a wide margin. This is most noted in British Columbia, where 15% of the entire rental stock is currently under construction, the highest of any province in our country. Rental rates are all but certain to continue to lower, and especially in BC. The Greater Toronto Hamilton area had 19 purpose-built rentals that have taken 12 months or longer to lease up, including 11 of those that took over 18 months and 7 took longer than 2 years to lease up. This is not really a time where you want to see a record amount of more rental supply coming up, at least not if you're a landlord. The other side, of course, is that renters are going to enjoy a plethora of options, an increasing amount of incentives, and continued lower rental rates. Pushing this further, the total amount of study permit holders in Canada, i.e. student rentals, is dropping dramatically, student renters. After peaking in Q3 of 2024 at 1,050,000, it's now down to 850,000 permit holders. Rental units in college towns are getting hit hard as far as rental rates is concerned. Meanwhile, though, homeowner starts with both condos and single family homes in that metric are running at the lowest levels since 2009. This points to the rental market continuing to soften and sets up a tightening of supply in resale coming maybe late 2026 and beyond.
Let's dive in now to the cancellation of projects, because much like Dan talked about, what will exacerbate the reduction in future housing supply is the outright cancellation of some of these projects. Urban Nation's latest Q3 2025 condominium market survey paints a really stark picture of the Greater Toronto and Hamilton area's new condo market, one that's hitting lows not seen in 35 years. The new condo sales in the Greater Toronto Hamilton area totaled just 319 units in the third quarter, the weakest result since Q3 of 1990. That's a 54% drop year over year and a staggering 92% below the 10-year average for this time. While sales are collapsing, project cancellations have surged. 10 developments totaling 2,499 units were canceled in Q3 alone, bringing year-to-date total to 18 projects and over 4,000 units that have been scrapped. That already breaks the previous record from 2018, and the trend isn't slowing down. Since the start of 2024, 32 projects, nearly 7,000 units have been canceled, with another 20 projects, roughly 4,200 more units on hold or in receivership, many of which are expected to be next. The combination of cancellations and near freeze in new launches slightly reduces inventory levels, though the change is all but marginal. Unsold new condo inventory across all stages of development fell just 2% year over year to 22,602 units. With that, unsold pre-construction inventory declined by 12%, and under construction units dropped by 9%. But there's one segment moving in the opposite direction, and that's unsold completed condos, which has skyrocketed by 142% year over year to a record of 2,944 units just sitting on the market. Price trends also tell another part of the story. Developers are now asking an average of about $1,200 per square foot, down from 3.5% a year ago and nearly 10% from 2 years ago. Still, that's far above the resale values, which comparable units are averaging at just $867 per foot, a 38% gap that continues to choke demand. Pre-construction units are priced even higher, averaging $1,315 per square foot, making it almost impossible for developers to compete with the resale market without taking losses. So construction activity has largely cratered. Only 2 new projects began construction in Q3, a total of 614 units, marking a 77% year over year and 88% decline below the 10-year average. So far this year, just 2,176 units have broken ground, the lowest level in 28 years. Overall, the number of condos currently under construction has plunged to 59,204 units. That's down 43% from the record of 104,000 and change reached in 2022. Interesting to note, too, that the prairies are outbuilding Ontario for the first time in 35 years. Housing starts are running at 70,000 annualized in the prairies, which is nearly 60%, 60% are in Alberta. Urban Nation probably summed it up best. The condo market has clearly become depressed as it undergoes a difficult correction following excessive growth that emerged during the pandemic. However, the lack of activity occurring today will surely lead to a lack of supply in a couple of years, helping to restart the engine for that particular market. In other words, this downturn may be setting the stage for the next cycle, but for now, the condo market is in a very deep freeze.
Okay, so we're about 6 months into the mortgage renewal wall and wanted to provide a bit of a mortgage update. So people renewing their mortgage today are seeing roughly a $105 payment increase per every $100,000 worth of mortgage that they have. We're currently in the highest rising payment cycle dating back to the 1990s. And it will continue to weigh on economic growth as what would have been disposable income. Well, they're taking that money and shifting it into things to help pay for things like higher mortgage payments. Mortgage renewals resulting in larger monthly payments look to continue until Q2 of 2027 when the renewal gap flips actually negative and those payments start to be lower year over year. For people renewing today, well, what is the most popular mortgage type? The majority, 43% of mortgages that are being either renewed or obtained today for the first time are going with 3 or 4 year fixed term mortgages. The second most common is variable. And the least sought after type of mortgage today, it's a tie between 5-year fixed and less than 3-year fixed. The reason for this is that people renewing today, well, they're essentially betting on rates being lower by the time that 3 or 4 year fixed term completes, and they'll renew at what they hope is a better rate. Or of course, they're in variable and they're just riding down the current cutting cycle. Payment wise, both 5-year fixed and variable rate mortgages are seeing almost identical payments based on their current interest rates. Though do note, this data was prior to Wednesday's rate cut, and that variable has been dropping at a much faster rate than fixed and will almost certainly result in lower payments in the coming weeks and months. Thanks to lowering interest rates and lowering home prices, the monthly mortgage payment required to purchase a typical home in Canada has dropped to the lowest amount dating back to 2021. We're at a 4-year low. Interestingly, sales volumes were 50% higher the last time average mortgage payments were at the rate they are now. So in that case, what is suppressing sales volumes today? Well, the most likely contender is consumer confidence. When the future looks bleak, you don't run out and spend $1 million on a home. Today, the consumer confidence index is running at near all-time lows and is currently below what we were experiencing during the global financial crisis. Canadians need confidence in the economy and its leaders to make large financial decisions. So until we have maybe a solid trade agreement, strengthening jobs market, and a viable budget from the government, sales volumes will likely remain muted.
It's very interesting, Dan. I feel like the government's loading up a big economic bazooka and they're about to blast it into the economy with the hopes that it turns it around. And speaking to that, let's look at the economic outlook because we have some indicators that point to where we can expect the economy to trend in the coming months. Employment insurance recipients were up 0.1% in August, and this is showing a slower pace of increase. But it is coming off of a 46% annualized increase over the last 6 months. The share of Canadians planning to cut spending due to interest rates sits at about 64%. And here's the big one. StatsCan shows consumer deposits at chartered banks up just 1.2% year over year in August. That's the weakest rate of growth since 2013. This demonstrates that the cost of living is taking up the vast majority of Canadians' income, and they don't have much left to deposit into savings. Consumer insolvencies lowered, however, down 0.7% year over year in August, and this is a sign that Canadian households are still managing their debt levels better than many had expected. But business insolvencies, they're also improving as well. They're down 20.4% year over year. But there just aren't many jobs out there. StatsCan just reported the amount of job vacancies has dropped by 2.4% month over month and are down 15.2% year over year. hitting the lowest levels since 2017. The agency says there were 3.5 unemployed persons for every job vacancy in August, the highest unemployment to job vacancy ratio since November of 2016. Not looking great out there, Dan.
Tough to get a job today, for sure. Okay, we are recording this on October 30th, and that means that basically most of the transactions and the data for this month have been recorded. All right, we only have a day and a half left of sales before the stats will be generated. So we have kind of a really good understanding of where the market is essentially going to pan out this month. And there are definitely 3 notable data points we wanted to share with you ahead of the official stats next week. Sales volumes have definitely increased this month. They are higher than August and September and are going to end up, by the looks of it, the second highest sales volumes for all of 2025 in October. Median prices are currently sitting at the highest dollar figure we've seen in all of 2025. And average prices are sitting at the second highest. So both of those clearly increased a fair amount coming off of the September numbers. So sales and prices are elevated this month, though still, let's be honest, they're below long-term averages, no question. So is October going to be a bit of a turning point on the heels of what's now been the most recent rate cut? Or is this just an outlier and November is going to settle back into more typical numbers that we've seen through the first 3 quarters of 2025? Well, we're going to have a full report for you next week, along with the biggest news in Canadian real estate, combined with what we are seeing in the marketplace on a daily basis. Thank you so much for watching. Hope you had a wonderful Halloween, and we will see you here next week.